María.
Sí,
Sí, esto no sé cómo quieres, si empezamos o falta muchísimo
eh,
conectarse.
ya, sí, no sé si...
O si queréis esperamos un par de minutos más. We wait a couple of minutes. I think, Maria, maybe we should start. And, since we're doing first the presentations, and
Yes.
I'm sure more people will be joining. Well, just to introduce myself, I'm the chair of the Alternatives Investments Committee that we created some years ago at CFA Spain. And CFA being more traditionally on liquid markets, we decided to create this committee to present awareness of alternative investments. And we have done presentations in private equity, venture capital, real estate, private debt. We did some time ago a presentation on crypto, and Maria proposed us to create a subcommittee to gather all the people that are interested in crypto. And we just created a couple of months ago, and probably this is the first event where we formally present this subcommittee. And I will let Maria do a brief introduction of this subcommittee, and we can start with the presentation. Thank you very much.
Thank you, Alejandro. So good evening, everyone. I'm very happy to introduce finally the new Digital Asset Committee, which the main goal, I think, is to bring this, what I find fascinating world, but sometimes misunderstood, closer to our CFA community. So for those who don't know me, I'm Maria Guinda, and I've been managing crypto investment funds for almost 10 years now. I know that in many occasions, this market has been surrounded by a lot of noise. There's been many hacks, scams, and opportunistic visitors. But what I would like to convey is that behind that noise, there's a very, very interesting technology with a tremendous growth potential. And to fully unlock this potential, it's important to go beyond simply seeing it's a new asset class, which are these tokens, and understand that this asset truly involves exploring topics as diverse as economic equilibrium, game theory, governance, decentralization, and above all, financial innovation, which I think are very, or I find like very intellectually super stimulating topics, and that I think that under this type of framework that the CFA events offer will be very well received. So, of course, we cannot ignore that this technology still has a growth potential that we can all take advantage of, not only as academic or technical, but also from an investment point of view that will play a very important role in today's portfolio and in the future. So with this committee, our mission would be to offer educational and informative events that bring this technology closer to everyone. And I'm sure that, and I hope that you will all enjoy. So thank you for joining today. Today's webinar, our first one, is going to be presented by WisdomTree. For those who don't know it, WisdomTree is an American asset manager with global presence. They only offer listed products. They have over 300, I believe, products, and they've always been innovating when building investment solutions, not only in crypto that they do, but also in other verticals. The proof is that they were the first managers in Europe that back into 2019 launched the very first physical back Bitcoin ETP. So I'll leave you with Carlos, who's also a CFA and works in Wisdom as a sales director for the Iberian market. Thank you, Carlos.
Gracias, Maria. I'm going to try to share my screen. Please let me know if you can see it. And I'm going to put in full screen. Can you see it? Yes?
Yes.
Okay,
Yeah.
perfect. So, well, first of all, I would like to thank you on behalf of Vision 3 Europe for this opportunity to participate in this CFA webinar. As Maria said, Vision 3 was a first mover in the new asset class of digital assets, and as a result of this, we have a dedicated and experienced digital asset team. And today, we would like to share the following agenda that I hope that you can see in the screen. We are going to start with a market update where we will cover the main aspects that are developing in the crypto space. We are seeing how the appetite for Bitcoin from institutional investors is growing, with some of them starting to include Bitcoin in their portfolios. Therefore, in the second part of the webinar, we are going to cover arguments and the enhancement in performance metrics when we include small allocations of Bitcoin in a well-diversified portfolio. And finally, the last part of the webinar, we are going to cover low fees solutions for institutional investors to take exposure to crypto. More specifically, we are going to cover ETPs, physical replication, exposure to the spot price. I encourage you to share with us your questions. You can use the chat in Zoom, and at the end of the webinar, we will try to cover all or almost all of them. And finally, this is the most boring part of the webinar. Let me give me please some seconds to show you this disclaimer, which I'm sure is very familiar to all of you. We just want to highlight that the content, and I'm going to read it, the content of this document does not constitute investment advice, nor an offer for sale, nor a solicitation of an offer to buy any product or make any investment. And now it's time to give the floor and to introduce to my two colleagues from Wisdom 3, from our digital assets team, Dovil Silenskite. Sorry for the pronunciation, Dovil. Dovil is a director in the digital assets research team, and Blake Heyman, senior associate in the quantitative research at Wisdom 3. So I'm going to stop sharing my screen. Blake, I think that you go first. So
excellent, perfect.
Okay.
I will share screen and take it over from you. Thank you, Carlos.
Welcome.
Thank you for the nice introduction, and thanks for having us here. Really appreciate everybody taking the time to talk about crypto, especially in the evening after a long day of work. So always, obviously crypto never sleeps. So anyone that is involved in the digital asset space also is always paying attention to markets. So as Carlos said, we'll run through a couple of different topics here. The first being a crypto market update, and then followed by talking about how we discuss portfolio construction with our clients, as well as talking about some of the advantages of using exchange traded products that are regulated and listed vehicles on exchange for institutional investors. So to dive into the market update, I always like to start things essentially taking a look back at where we've come from, because a lot of the actual allocation decisions, people are naturally trying to time the market because it is for many people, their entrance into a new asset class. So the concept or the language that is often used is, I think I missed it. And, the actual, getting on board with the investment case is a hurdle that has evolved and progressed a long ways over this period of time. So as we've seen, I would say the evolution of knowledge, we've gotten the majority of institutional investors on board with the investment thesis behind Bitcoin, Ethereum, and digital assets more broadly. But then in evaluating timing and evaluating allocating in terms of their asset allocation is always a question. And in terms of the timing, they always tend to look back at recent performance and see the strong performance and bring the question up, okay, it performed very well over the last year. How could it do it possibly again? Now, the thing that I would just kind of highlight here is that it's a growth asset. So, and it's obviously highly volatile. So there are still many new adopters entering into the space. So a lot of the conversations we were having at the start of the year were very similar to that we're having now. And it is those quotes, I missed it. Now I'm going to wait to go ahead and allocate. And the key thing here is it's an early stage asset. So making those allocations sooner than later, as long as they're comfortable with the investment case, comfortable with the asset allocation and the portfolio construction is really a key thing. And then looking back, it's one of those interesting things to look at, particularly when you look at multiple calendar years, which we'll show a chart later on, is that we've seen Bitcoin perform over 100% last year. We've had a very strong year for gold this year, and Solana also outperforming a lot of other digital assets and all traditional asset classes alike. So in what was shaping up to be a very challenging year for digital assets, particularly in terms of the macro environment, with rates remaining quite high and liquidity remaining relatively tight, digital assets still outperformed all traditional asset classes. So this is always an attention grabber for most traditional multi-asset managers. And for the Bitcoin maximalists that are very much on board with the investment case of store of value and long-term store of value and digital gold narrative, the fact that gold and Bitcoin are at the top of this list, where obviously your equities are a little bit further down, makes a strong case, particularly with your US dollar returning negative, obviously due to inflation and other effects. So a lot of the strong performance that actually catapulted digital assets to start the year was the approval of listed products across the globe. Really, we've had products in Europe for 5 years now, but the entrance of the US into this market, allowing for Bitcoin exchange traded products to be listed starting in January, is really what catapulted the price over the first 3 to 4 months of the year, and propelled Bitcoin up to close to new highs, not actually surpassing those highs, but very close to that right around that 70,000 mark. And that really was another impetus for more flows globally and more attention globally. So we saw listings get approved across Hong Kong exchanges, across Australian exchanges, Thai exchanges, and notably the London Stock Exchange, which is what we recently added to the listings that our Bitcoin product is available, Bitcoin and Ethereum product is available on. So we are seeing greater institutional adoption and regulatory adoption across the globe, and most developed market exchanges now have Bitcoin or Bitcoin and Ether exchange traded products available. So a key inflection point as we're navigating the overall growth and adoption of this new asset class. So far we're sitting at roughly 70 billion in AUM. I would say about 18 or so billion of that AUM was net new flows to start the year into the Bitcoin exchange traded products. So a strong demonstration of the popularity of these investment vehicles, particularly because of the ability to essentially offboard a lot of the complexity that's associated with managing private keys, as well as the concerns that are associated with adopting additional compliance reviews and all the other details that might be involved if you are managing your own security infrastructure or trading infrastructure. So the fact that the exchange traded products and exchange traded funds in the US plug into the traditional financial market and your trading systems in the exchanges really made for a very easy way to access this investment in a secure and regulated way, which was a lot of what was required for institutional money managers to actually move into the space. Now, to demonstrate some of those new entrants into the market, we've gone through some of the recent SEC filings to look at some of the key holders of these Bitcoin ETFs in the US, given that this is really the newest development and where we've seen the majority of those inflows taking place. There are some interesting names that show up on the list. Obviously, you have your major hedge funds like Millennium, probably taking somewhat of non-directional bets by taking advantage of different things involved in the futures markets. But also, more notably, you also have firms like Morgan Stanley. You have firms like the State of Wisconsin Investment Board, a pension fund out of the U.S. allocating over 180 million, and as well as InvestNet Asset Management. So you are seeing, I would say, more traditional investment managers entering into the space that have more conservative risk profiles. So with the State of Wisconsin Investment Board being a pension fund, obviously managing their assets and liabilities and making sure that they can pay out to the pensioners that are the employees of the state of Wisconsin, having a small allocation to digital assets and Bitcoin particularly is a recent development that has happened since these new launches. And then we're just getting started with Morgan Stanley and InvestNet with the essentially the home office of many registered investment advisors in the US that are managing, I'll say, regular people's wealth for their retirements and their 401k accounts and their IRA accounts, et cetera. So the retail space essentially has beaten traditional asset management and traditional investment managers and institutional money managers into this space. But we are seeing institutional pick up, and we are seeing it kind of entrance from a broad swath of perspectives here. And you could even see some other notable small holders with Tudor Investment Group and Renaissance Technologies also at the bottom. So some very high profile names on this list are beginning to allocate. Now, starting to look ahead, obviously today, I believe actually about right now, we are getting the announcement for the US Federal Reserve rate cuts. We had an inflation print this morning for the UK. So we are coming to the essentially the end of a very tight rate cycle. And we are awaiting the Federal Reserve to make the announcement for the cut. I don't know if it's 25 basis points, 50 basis points today, but this is a step in the direction of adding additional liquidity into the market, which has historically benefited digital assets, particularly Bitcoin, which is shown here on this chart. So doing extremely well in the ZIRP era, which the zero interest rate policy era. And even, with our recent recovery still kind of going against the trend here. So the fact that Bitcoin has this long-term store of value, this fixed supply, and it allows for this new public payments ecosystem to be available and not dependent on any centralized counterparty, really makes for quite a unique investment case and almost an alternative asset class that kind of gives you an alternative monetary policy in a way that can combat what we're seeing in the traditional financial markets. And to exemplify that, there's obviously the Bitcoin halving that took place this April, which you can kind of keep in mind that this is very much a function of the inherent codified monetary policy of Bitcoin itself. So roughly every 4 years, the new issuance of Bitcoin is cut in half, which essentially reduces the overall inflation. So it is a consistently tightening monetary policy until that inflation goes to zero and we reach the maximum 21 million coins that become available. Historically, what we have seen is during or after these halving events, supply remains relatively tight, and we do see a bit of a squeeze in terms of positive price action going forward. And historically, we've seen very, extremely positive price action, upwards of 4 times the 400% price returns. Now, I'm not going to say that that's going to be something that, may happen with this instance, but it is one of those things that happens every 4 years, and it is very analogous to a traditional financial markets monetary policy action. So it does have an effect on the market. I'm not claiming that it will, catapult things in the way it has historically, but this does introduce a bit of a more tighter supply regime going forward than we have seen historically. So as you're starting to combine these two factors, this increased liquidity in the traditional financial markets, understanding that Bitcoin and digital assets more broadly are still a risk asset, as well as you do have this this tightening supply dynamic, it could make for quite a positive outcome going forward, especially when you meet that with the increased institutional demand that we have been seeing with the exchange traded products and those broader regulated vehicles. Now, moving forward to some other developments that have to do with the actual technology that is enabled through these platforms. Now, focusing more on Ethereum, the second largest digital asset by market cap, which has programmability embedded into the code of the blockchain, which allows for programs to be built on top of the blockchain. And you can think of these programs as being applications and services, which lend themselves to become very efficient when you are working off of the same data set as everyone else, and you are working off the same computing platform as everyone else. So it tends to be, and this is what people talk about as a lot of the benefits of adopting blockchains, is this transparency, this decentralization, a lot of these efficiencies. So where we're seeing some disruption is we're seeing a lot of traditional assets actually being tokenized and moved onto the blockchain, because rather than having your trade settle in 2 days, it can settle essentially atomically, instantaneously via the blockchain. So this is one of the many ways that institutions are actually getting involved. So namely Wisdom Tree, BlackRock, there's some other names that are prominent names that are out there, tokenizing traditional assets, bringing them onto the blockchain, now actually surpassing $3.5 billion in US dollar value across commodities, equities, fixed income, you name it. And they're all integrating directly with the blockchain, bringing, so they're essentially bridging the gap between the traditional financial markets and the decentralized financial markets. And why this is important is because of a lot of the efficiencies we just mentioned, and as well as the usership that is on the decentralized world. So to give an example in terms of efficiency, Uniswap is a very prominent decentralized exchange that lives on Ethereum and many other blockchains. It does very similar amounts of volume as Coinbase, but trades at a fraction of the actual value, and is what I would argue as more efficient than Coinbase. Because when you think about it, Coinbase has X number of employees managing the actual exchange itself, whereas a Uniswap is just code deployed on the blockchain. It has a few foundations, building out the interface, as well as open source developers seeking to enhance it. But at the end of the day, it's an open source technology that is available online, that everybody can look at this code and verify that it's doing what it says it's supposed to do, servicing a lot of traders that are involved in this ecosystem to allow for efficient exchange, and essentially now removing what is a lot of filling the gap that market makers are currently filling the gap in the traditional financial markets. So there's a lot of unique things that are here that can lead to efficiencies. So, and there are a lot of users in this space as well that are really making, I would say, putting together a positive picture going forward for this decentralized finance revolution that is, particularly taking place on Ethereum to start. Now, shifting gears a little bit, we do have to pay attention to usership and what people are doing. And what has been a recent development is that Solana has actually gained a lot of usership and a lot of attention more recently because of certain activities that have been taking place on the blockchain. For example, increased meme coin trading activity, new other decentralized platforms that have made it extremely easy to do very cheap, very frequent trading. So it has garnered a lot of retail use. Now, it does obviously have significantly cheaper transactions and faster transactions than Ethereum, and it did come after Ethereum, at least in terms of its overall I'll say rate of adoption and number of users, as well as even the infrastructure that's available on the blockchain. But it is something to note that where the users are, a lot of the actual development goes. So far, Ethereum has really been the first mover with a lot of the usership. So a lot of the actual applications have been built out on Ethereum, regardless of how expensive it is to transact and some of the other challenges that are involved there. But Solana is really picking up steam, and it is something that we do want to watch, particularly as we are seeing some institutions move in and get involved in the payment space like Visa and MasterCard. So as we kind of tie all these pieces together, there are quite a few things happening in the space. But to wrap this up, and we do have an outlook that anybody, I mean, we're happy to share, and if anybody would like to follow up. But the key things is that there's higher demand due to this new wave of institutional adoption and this broader I'll say this more easily accessible tool set that is now available through digital asset exchange traded products across most developed market exchanges. So that's a new wave that is now a new door that has been opened for demand. We're also seeing the rate environment in traditional markets shift a bit. That could allow for more liquidity to enter into the system and people to move further out on the risk spectrum, getting involved in digital assets and making allocations. Particularly as we see rates, there may be some money moving into decentralized finance because of the alternative yield bearing opportunities that are there. And then when looking at Bitcoin, we do have this cyclicality and this tightening of supply that is due to the halving that takes place roughly every 4 years, that should essentially tighten the supply demand scenario even more when you start to look at things holistically between the overall adoption with institutions and this and the effects of the halving. And then we have the greater adoption through these new developments, particularly with tokenization and DeFi platforms that enable users to access different yields, access products and services cheaper than they may access them in traditional markets, and even do things that may or may not have great use cases, but the users are gravitating there. And the fact that we now are reaching a stage where 1 billion users have Bitcoin wallets, there is a strong trajectory going forward for this asset class. So that really covers the quick market update, as well as leans into the outlook going forward. Now I want to spend some time focused on digital assets and Bitcoin, particularly when you're investing from a multi-asset portfolio perspective. We have 2 white papers covering this topic. The majority of what I'll cover today is covering something that we covered in the first one, and then we'll highlight some of the new developments in the second white paper, which are available on our website. So, but happy to discuss further if anybody's interested. So, contrary to popular belief, digital assets are still quite decorrelated to traditional asset classes, particularly when you do look at weekly return profiles. Now, if you are trading a particular event like a CPI print or something that is more daily, it is like these assets may definitely trend more in line with your higher risk tech equities, if you will. When you start to look at these numbers across a weekly return profile, and even over just the last 2 years, they're quite decorrelated with other assets, given this adoption curve that's taking place, given the alternative, I'll say, internal codified monetary policy that is baked into these blockchains. So you can see here that Bitcoin has lower correlation to all assets, even more so than your commodities. So a lot of people are highly aware of the fact that you're allocating to commodities because you are looking for them for a diversifier. You're not looking for income there. You may be looking for an inflation hedge there, but Bitcoin offering many of those same characteristics with a lower correlation profile. So this is one of the key advantages of Bitcoin, is really just the decorrelated nature of this asset. And then when you look at it historically and where it's at, even though it is, just over 10 years old, in the last 10 years, it was the best performing asset class in 7 of those years. And the other 3 years, it was the worst performer. That happens to also overlap with the halving cycle. So the previous halvings took place in 2016 and 2020. So dead center between those halvings is the worst drawdown for the Bitcoin cycle. Now, the reason I highlight this is, 1, the cyclicality that we referenced beforehand, but 2, the extreme growth potential that is available here. Now, last year, at the beginning of the year, people would have probably, people would be very surprised to end the year with up 150% for Bitcoin. And the fact that we're still up, if I'm not mistaken, it was 35% so far this year for Bitcoin. I think people are quite surprised at the growth potential here, particularly when you are comparing it to other asset classes. So the fact that this is still in its early stages and has this decorrelated nature makes it quite a nice potential tool to add to the portfolio, and at a minimum be seriously evaluated for that. So to begin to do some of this analysis, the first thing that we did is we just took a very basic approach of looking at the overall universe of globally listed assets to determine what does a liquid market portfolio look like if you are just market cap weighting according to everything that is available as a rough benchmark. And if you do that, what you'll find is that Bitcoin and digital assets, now more broadly sitting over the 2 trillion mark, make up roughly a little over 1% of that market weighted portfolio. So even when even when you're looking at, say, inflation linked bonds as a potential allocation, that's roughly the same size in terms of market cap weighting as your digital assets allocation. So this asset class has grown significantly and has now been around long enough that it does have a place in traditional multi-asset portfolios. And we make the strong case, and we are strongly behind the view that if you're not including digital assets, you need to have a thesis behind that. So you are actively choosing to be underweight something that should be a part of your benchmark in your portfolio. The same way that if you're going to go underweight emerging market equities, you typically need a thesis to do that. So we are saying here that if you're not going to include digital assets roughly around the 1% mark, you are making an active bet against the asset class. Likewise, if you are overweight, you are making an active bet for the asset class. So we've done some very basic historical analysis, just including Bitcoin in a portfolio, taking away 1% from your traditional equity allocation and your traditional 60-40 equity fixed income allocation, and starting to add 1%, 3%, 5%, and 10% of Bitcoin to your portfolio. Many of you may have already seen this, or maybe have ran this analysis before. But the key things that we really like to highlight is that small amounts, because of the decorrelated nature of the asset and the growth profile of the asset in terms of performance, the trade-off for your actual volatility to your actual return potential is quite positive. So when you're looking at your traditional 60-40 portfolio versus the 1% Bitcoin portfolio, you essentially are getting an additional 60 plus basis points of overall outperformance versus that 60-40, and you're only really adding 5 basis points of volatility to your portfolio over a 10-year period. So these are some of the effects that I think that are quite interesting to look at. So just by adding this decorrelated asset that does still have significant growth profile or growth potential can lend itself quite nicely for increasing that Sharpe ratio. And something that's not necessarily shown here is that the information ratio of doing this is actually extremely high. It's right about 1. So for deviating a very, very small amount from your benchmark 60-40 portfolio, the actual active risk that you're taking gets compensated extremely, extremely well for doing so. So in the second wave of our, or second version of our research, the expansion of our research, we've moved into doing some more portfolio simulations and some more advanced quant work to evaluate allocating to digital assets. And how we've approached is really in a couple of different ways. The first way is by applying bootstrapping, so essentially taking historical returns and simulating them by randomly grabbing a given month from Bitcoin's historical performance time series and stringing those together over time and looking at those over a 3-year period and seeing what is the total distribution of outcomes. And if we look at that as from a relative max drawdown perspective versus your traditional portfolio, how can we be sure that we're never going to go past a certain threshold that we might have? So this is very much in tune with coming up with an answer to the allocation question by asking, okay, if I'm willing to, if I want to be 95% sure that I'm not going to exceed an additional 1% drawdown to my portfolio by adding Bitcoin, what's the allocation of Bitcoin I'm allowed to have? So roughly the numbers generally end up being, if you don't want to exceed a 1% drawdown, you shouldn't really be allocating more than, say, 1.3% to Bitcoin. So you really need to kind of take into account that you need to be willing to, have a year that might have a drawdown of 70%. We also went further to look at things from a risk contribution perspective, particularly when you're looking at an alternative sleeve. So when you are looking at your alternative sleeve, one of the benefits of these digital assets is that looking at Bitcoin here, but looking more broadly at the whole ecosystem, you can kind of look at particularly Ethereum and all of those that have the smart contracts capability as liquid venture. So you do have the benefit of a lot of liquidity, but obviously you're taking on a lot of volatility by doing that. So it ends up eating into your volatility budget when you are making those risk contribution based allocations in your portfolio. So that is something to be mindful of. But when you're making those evaluations, I think it is important to understand the trade-offs from a liquidity perspective, because your actual private equity or your venture exposure in outside of this crypto space is obviously not getting marked to market as often. So your actual volatility calculation is obviously one that is questioned a lot and in the headlines a lot. So it's just one of those trade-offs that's worth evaluating, and then based off of how much based on how much volatility you're willing to allocate, you will end up with a series of different capital allocations according to the other assets that are in that portfolio. And then the most interesting from my perspective is doing the Markowitz mean variance portfolio optimization, taking into account future expectations. And I would say the key thing that we took away from evaluating that was essentially, if you're making the assumption, say in a bad case that, or in a very neutral to potentially bearish case for Bitcoin, that the correlation with other assets is going to increase, it's going to maintain its historical volatility profile, and it might only outperform equities by, say, 7% per year. And that would really only mean that Bitcoin's going to double its market cap in the next 5 years. So when you think about that, it seems to be a pretty, a pretty somewhat bearish / neutral case, a very conservative case to say the least. And the interesting thing is if you are running a portfolio that is 10 to 12% volatility, you're still going to have 30 basis points to 50 basis points of Bitcoin in their minimum. So essentially, if you do have the view that Bitcoin is going to outperform equities meaningfully and continue this trend of adoption and further growth, it's pretty obvious for having at minimum roughly a 50 basis point allocation, if not a 1% allocation that is in tune with, with maybe a little bit higher volatility levels, or even in tune with a more bullish outlook. So when we put all these pieces together, there's a lot of different outcomes, and I definitely focused on the conservative portfolio because when you are having conversations with these traditional asset managers, you are definitely having a more conservative conversation. But from a lot of these analysis, what we found is that the allocation range is typically from 1% to 5% based on the methodology you're using. So a lot of, if you're looking in the worst case scenario, a 1% should be the base allocation to this asset class. Now, if you are having much more of a neutral and a little bit more bullish stance and are willing to withstand a little bit of additional volatility versus your traditional portfolio, that's when you're starting to branch into the 3 to 5% allocation. And this is kind of how we hone in on determining fair allocations for multi-asset portfolios, and we are discussing with our clients. So with that, I don't know if I've gone a little bit over on time, so I apologize, Dovilia, if I did, but please feel free to take the reins and run through the benefits of crypto exchange traded products.
Thank you very much, Blake. And yes, I will keep this brief because we want to have time for your questions. But now if we could go to the following slide, please. So why exchange-traded products for investing into cryptocurrencies? For me, this is a very exciting question because I spent nearly 9 years at BlackRock covering exchange-traded products. And now I have an opportunity to cover exchange-traded products that have digital asset exposure within them. So from my perspective, this is the most sensible way of investing into cryptocurrencies, because it takes away a need for you to worry about technology, worry about remembering passcodes, worrying about dealing with unregulated or untrustworthy parties. ETPs, or exchange-traded products, are regulated in Europe. They have prospectus, they have official monitoring by various regulators and various institutions. So by going into them, you get confidence that your investment is managed in a secure manner. And also ETPs, they work with custodians, and a number of ETP providers, they have dual custody model, which takes advantage of different custodian strengths in order to keep the cryptocurrency safe and secure. And in case either the custodian or issuer goes bankrupt, your assets would still be safe and secure within the segregated wallet at that custodian. And also ETPs are great because they are an efficient way to trade. When you trade ETP, you trade on secondary market, so you avoid having the liquidity and trading costs related to investing into the digital asset directly. If we go to the following slide, please. Here, what I wanted to show you is the difference between European Bitcoin exchange-traded products and US Bitcoin exchange-traded funds. So in essence, exchange-traded product is an umbrella term that covers 3 types of exchange products: exchange-traded funds, or ETFs, exchange-traded notes, or ETNs, and exchange-traded commodities, or ETCs. In Europe, we tend to use the term ETP because some countries call these products ETNs and other countries call these products ETCs. So to avoid the confusion, we just take one term that captures both. In Europe, we do not use the term UCITS ETF for digital assets products because UCITS rules require max 20% exposure to a single asset. So if you have Bitcoin ETP, you have 100% exposure to Bitcoin, and there are no other assets to diversify in order to comply with UCITS rules. But there are a few operational differences between US products and European products that are very, very important to know about when you consider investment. The first one is creation redemption mechanism. In Europe, authorized participants provide digital assets to the ETP. So when there is a subscription, cash goes to authorized participant. Authorized participant acquires digital asset, for example, Bitcoin, and delivers Bitcoin into ETP. And when there is redemption, authorized participant takes Bitcoin out of ETP and then sells it and delivers cash to the investor. In the US, ETF receives cash, and ETF is responsible for buying and selling Bitcoin. As a result, in Europe, you only ever have exposure to digital assets when you buy crypto ETP. In US, you have exposure to both digital asset and some cash. And this can cause cash drag, which can be quite significant in markets that are as volatile as crypto markets. And it can also result in ETF experiencing trading costs, because ETF will need to buy and sell the digital asset, which results in costs. In Europe, this activity is done by authorized participant, and the cost of buying and selling a digital asset is covered by bid-offer spread. If we go to the following slide, please. So now the most important question: how do you choose the right crypto ETP issuer? And the way I think about this is you need to look at issuers' experience. And here, the most relevant experience is in managing physical commodity ETPs. So if an issuer has managed gold or silver or palladium or any other metal ETPs for the last 10, 20, or even longer time period, then that issuer knows what they're doing. And if they replicate their approach and their structure for digital assets, then you know that your investment could be secure. Then you need to examine cold storage best practice. So it's very, very important that the custodians that the issuer is using have the procedures in place to ensure geographic, human redundancies, ensure the safety of keys, ensure that there are multi-approval systems so that you do not rely on any individual just going rogue. Multi-custodian model is also important because one custodian may be better in one cryptocurrency, maybe better in other cryptocurrencies. So issuer can decide how much to allocate to each custodian, subject to what exposures the ETP has. And then what you need to demand from the issuer is transparency. And it's quite fascinating going from one issuer's website to the others, because the level of disclosure that they have is very, very different. So for you, it's very important to see that you know what you're buying. So if you have one share of ETP, how much this digital asset do you have? If you have one share of Ethereum ETP, how does staking work? And does the ETP involve itself in coin lending? Because that could introduce additional risks. Then you need to examine how you can specifically, can you trade it in a currency that you want? For example, if you want to trade in sterling, can you trade it in sterling? If you want to trade in US dollar, can you trade it in US dollar? And can you trade it on your preferred exchange? Most crypto ETPs are listed on SIX, Euronext, and Sector exchanges. Few are listed on London Stock Exchange. So subject to what you want to use, one may be more appropriate than the other. And the last item that you need to examine is fees. Because when you pay 0.5% or you pay 2.5%, the 2% difference can have a very significant impact over time, as those fees also compound. So I'll stop here. I know that we ran over by 1 minute, and let's see if you have any questions for me or Blake to answer.
Yeah, there is a question. I think that is for you, Blake. Is related to the correlation of Bitcoin versus asset classes. The question is if the correlation of Bitcoin versus the rest of the other classes that you showed in the slide has increased over time.
Good question. So it has slightly, but not in a meaningful way. So this chart here shows a 10-year history. Because we get this question a lot, we actually do have in our other longer slide decks, we do have a second one that shows the returns over the last 2 years. And in that chart, you'll see that the actual correlation might increase by 2 or 3 percentage points across some of the more obvious asset classes like equities. I think small cap equities ends up being one that jumps up to like maybe 24% or so. So the answer is yes, but not in a way that it affects this actual the decorrelated nature of the asset.
Thank you, Blake. So there's no more questions. So thank you very much, Maria. I'm going to give you the floor just in case that you want to close the webinar.
Yes. So no, I just wanted to thank you everyone for joining today, this time of the day, and being here for our first event. But I will especially have special thanks to Wisdom Tree team for this insightful presentation and for being part of this committee also. So going forward, we will be organizing new events on digital assets, covering many different aspects on the technology and on the asset class. So I hope that you will join us and that you enjoy it.
Thank you.
Thank you, everyone.
Bye.
Thanks, everyone.
You.